we're probably better off than we were a few years ago. A lot of resilience has been built since the terrible days of 2008, 2009. But what we are seeing again is this search for yield, almost a desperate search for yield. And that can go wrong. I mean, that's exactly what happened in 2003, 4, 5 with disastrous results. And that then poses the question, so how resilient is the financial system? And it is not yet as resilient as policymakers want it to be. There's a transition for getting to the new Basel capital standard, the new this standard, the new that standard. So the world is becoming riskier again before that transition process is complete. And so, in the kind of ever-used phrase, the regulators are going to have to be pretty vigilant. Yeah, I think they are. I mean, on terms of bank capital, there's a pretty clear roadmap up to 2018, 2019. There are important pieces to fill in. It's a technical area, but there's a review of capital requirements for trading positions going on. This is a big missing piece. We might come to it, but the authorities need to fill in the resolution regime. How will they sort out big banks, big dealers, if they fail without taxpayer money? But the biggest issue of all, I think, is the more you re-regulate banks, the more you can be sure that risky activity is going to move elsewhere. And that provides or presents a really big challenge to the authorities, because it requires them to be nimble and flexible, and yet what society has traditionally wanted is a rule book. And it's wanted their rule book for a good reason, which is Congress, Parliament, doesn't want to hand over arbitrary powers to regulators. That's a pretty good argument in a democracy. But if you write a detailed, static rule book, the seeds of its own destruction have been sown. Finance is a shapeshifter. And so we've got to get to a position where the regulatory authorities have more discretion, but constrained discretion. And that debate, I think, has hardly got going yet, and the world won't be a safe place until that debate has occurred and a more flexible but disciplined regime has been put in place. And I think that's quite a challenge in the US and in some other parts of the world. Well, it's less alarming than it was 2 to 3 years ago. That's for sure. I mean, there was a point, I can't remember exactly when, but it looked as though the whole thing might unravel in the most almighty mess that would have made the crisis of 2008 look small, in my view. I mean, this is the closest we have come to a complete global meltdown, and it didn't happen. The European authorities got through that. So things have improved, but there's more to be done. Their stress test this year, what they call the asset quality review, this is the biggest known event of 2014 in finance and in some respects for the world economy. How rigorous that exercise is, and how many banks fail, and what happens to those banks. I mean, this is enormous, and I don't know what will happen. Some people are skeptical about whether the European authorities will approach it in a tough spirit. I don't agree with that. I think the incentives facing Mario Draghi and his colleagues at the ECB as the new kids on the block, as it were, as supervisors for the big European banks, point all in one direction. And these are serious people, and they know the stakes are high. But beyond that, they're developing the monetary union into a banking union, not only with the single supervisor, but also with a resolution regime. But in my view, they haven't yet done enough on deposit insurance. Deposit insurance is still different in each member state, and they would be much better off if they had a common deposit insurance regime. And behind that, of course, or implicit in that is, don't they eventually need to move towards fiscal union of some kind? And my view is, and has for a long time been, yes. And so the stakes are still high. They're still building a completely new system. and that takes a while, and they're having to do it in weak macroeconomic conditions. So it's still a challenge. I'm not sure it's as big as 2007, but it'll be there, and it'll be growing, and if left unchecked, it will eventually become very big. Again, as I was saying earlier, the nature of finance is to be shape-shifting. You could write a bank as a bunch of derivatives contracts. You could write the derivatives business as a bunch of insurance contracts. Re-regulating only banks will mean that the fragility of excess leverage, excess liquidity, or maturity mismatch will just turn up somewhere else. And this is very hard, because if you said to me, so where precisely is it going to turn up? Is it going to be in money market funds or credit funds, or, well, it could be in all sorts of forms that no one has even thought of yet. So how can you regulate for something that doesn't yet exist? And this is why I say that Congress, Parliament, sooner or later, and in the UK this has happened up to a point, are going to have to frame regimes where regulators are given a very clear objective and are constrained by that clear objective, but are given more discretion than they have had up to now to protect society from instability. I think that debate hasn't really begun in the US. Close. The US has a pretty good legislative regime for the resolution of these so-called systemic firms. Europe's got a really good legislative regime for it. I think the only reason it's marginally better is it was done later, and so they'd had more time to think. It's not enough just to have the powers, though. You also need these organizations structured in the right way. I think the US is somewhat closer to that than Europe. But there are missing pieces in the regime. The key underlying issue is, so when equity is exhausted, where do the losses go? Well, we don't want them to go to the taxpayer, because that's wrong. It's morally wrong, and it creates terrible incentives. They need to go to bondholders. Bondholders and banks and dealers and elsewhere should take risk just in the way that they do when they invest in motor companies or computer companies' bonds. But then the question is, so what quantity of bonds should these big firms have in issue? And I think we're promised the answer from the international authorities by the time of the G20 Brisbane summit in the autumn. This is really a crucial moment for the international reform program. People talk as though it's now the implementation phase, but that's not true. There are really big pieces missing, not because anyone had forgotten about them, but because the whole program is sequenced. And there's a crucial moment for both shadow banking, which we talked about briefly, but especially for this resolution. In the jargon, it's what will be the gone concern loss-absorbing capacity requirement. In layman speak, what quantity of bonds are these banks and dealers going to have to issue so that there's an ability to recapitalize the banks by converting bonds into equity? That's the really big remaining policy question. I think the scariest period, or one of them, in some respects, was between October 2008 and March 2009. So the year leading up to October 2008 was terrible, because there was this on-off liquidity crisis, and it got worse. Bear Stearns fell over, Northern Rock in the UK, and then it would get better for a while, and then it absolutely became a crescendo. And here's the key point. The authorities used their blunderbuss, their bazooka. The authorities internationally decided to put the fiscal authorities behind the capitalization of the banks. A desperate move, but an immensely powerful move. And yet, as we went into November, December, and into January and February, the system was still wobbling. The world economy was crashing away. that was pushing up default rates and weakening the banks, and weakening, therefore, prospectively governments as well. And it wasn't until the US authorities, the Federal Reserve and the US Treasury, did the stress test of US banks to find out just who was fatally flawed and who needed more capital. Wasn't until that exercise had been done, and done successfully, that things started to improve. And that was the scariest period, because no one knew what would work. Once you've played your biggest card, there isn't much more you can do. We're standing behind the banking system, and yet confidence isn't recovering. And I think the people that ran the stress test here, I think they really did help stabilize the global financial system.